The quantum computing sector is moving in opposite vertical directions. While technical engineering is accelerating at a historic pace, the market valuations for the companies building that tech are in a state of collapse. The industry is successfully moving out of the noisy, experimental phase. We are seeing the first concrete steps towards scalable, fault-tolerant quantum computation. But the 2026 equity market is brutal. Macroeconomic pressure and rising rates have severely compressed the multiples for almost all pre-profitability growth stocks. This chart tracks that divergence. The primary challenge is determining which entities possess the combination of technical superiority and sovereign financial support needed to survive this drawdown. For investors who can separate engineering results from market panic, this discrepancy represents a significant asymmetrical entry point. The pressure on the sector is driven by the Federal Reserve's persistence. With benchmark interest rates held between 3.50% and 3.75%, the market is demanding a rigorous flight to quality. Geopolitical instability has caused a rotation away from high beta tech, resulting in 76% drawdowns for top quantum pure plays. However, the race for quantum supremacy has become a matter of national security. This strategic importance helps shield the sector from total capital abandonment. Through the reauthorization of the National Quantum Initiative and expanding defense contracts, organizations like the Air Force Research Lab are effectively socializing the research and development costs for the industry's most viable players. This leaves you with a distinct trade-off. You can chase the 10x upside of hardware purity while risking a total loss, or move toward the relative safety of ecosystem security. Sovereign backing provides a buffer for the most viable players, but choosing an unsuccessful hardware architecture still carries terminal risk for an individual investor. IonQ is currently the preeminent pure play. They lead the sector in absolute revenue scale and have achieved world record gate fidelity. Their hardware utilizes trapped ion systems. While processing speeds are slower than some rivals, the architecture allows for all-to-all connectivity, which significantly simplifies the software compilers. In 2026, IonQ's $1.8 billion acquisition of SkyWater Technology transformed the company into a vertically integrated manufacturer. By owning their own foundry, they have reduced their chip prototyping cycle from 9 months down to just 2. The trade-off is the price. You are paying a premium of over 83 times forward sales for that shortened roadmap. Rigetti Computing is the primary rival in superconducting circuits. Their architecture offers rapid gate execution, though it typically deals with shorter coherence times than ion traps. Rigetti's financial position is a key advantage. With a $589 million treasury and a lean burn rate, they maintain roughly 11 to 12 years of runway, allowing them to focus on engineering without immediately tapping the capital markets. Buying either of these two is a direct bet on their underlying physics. You are relying on their specific architecture reaching commercial viability before their cash reserves dry up. D-Wave Quantum is the current momentum leader. Their focus on quantum annealing allows them to solve real-world optimization problems today, while others are still in the proof-of-concept phase. Their 2026 acquisition of Quantum Circuits Inc. added gate model technology to their portfolio. This dual-platform strategy helps mitigate the risk of being limited to a single annealing architecture. The primary risk with D-Wave is shareholder dilution. Heavy use of ATM offerings has built their cash pile, but a looming overhang of venture capital shares could cap near-term gains. In the moonshot tier, Quantum Computing Inc. is attempting to build room-temperature photonics machines. This strategy avoids the massive costs associated with cryogenic cooling. QUBT offers high leverage with over 20. This allows you to bet on the sector's success while mitigating the impact if any single hardware modality fails. Alternatively, the QTM ETF prioritizes established semiconductor giants like Teradyne and Micron. It offers a lower beta return driven by infrastructure providers. Then there are the infrastructure hedges. NVIDIA has positioned itself as the simulation standard for the entire sector. Through its Q-Quantum platform, NVIDIA's revenue scales regardless of which hardware architecture wins. If quantum computing advances, demand for these simulation tools increases. These ETFs and infrastructure players offer a path to participate in the quantum transition while structurally limiting the extreme volatility of a single hardware failure. Buying into a sector where stocks are down 30 to 50% year-to-date requires a shift in your investment mechanics. You must align your expectations with the engineering timeline. Achieving significant returns in this space requires capital commitment through the 2028 to 2030 commercialization window. Standard 5 to 10% stop losses are generally ineffective here. The extreme intraday volatility of these microcaps will very likely shake out retail investors during normal market swings. Instead, use a time and technical stop loss. This means tying your exits to fundamental engineering milestones, like chip connectivity or gate fidelity, rather than daily price action. Successfully investing in this transition requires moving past short-term trading habits. You have to evaluate the science, not just the ticker symbol. This allocation model shows how to apply these risk profiles to a single $1,000 hybrid portfolio. We start with a $400 foundation in the WQTM ETF. This provides broad exposure across the pure play sector to mitigate the failure of any single hardware company. Next, allocate $250 to IonQ. This secures a position in the market leader, which now possesses a $3.5 billion cash runway and its own manufacturing foundry. Add $200 in D-Wave to capture near-term commercial revenue from their optimization platform and their new dual-platform hardware. Finally, use $100 on NVIDIA as an infrastructure stabilizer and place a $50 lottery ticket in QBT for photonics upside. By systematically mapping these risk profiles into one allocation, investors can navigate the current market noise and position themselves for the 2030 exit horizon.